Well, thanks very much, Majura, and g'day everyone. Can I begin today by acknowledging we meet on the land of the Yagara and Turrbal people and pay my respects to their elders past, present and emerging, and thank them for their ongoing custodianship of the lands, winds and waters we all now share in Queensland. Can I acknowledge my good mate and ministerial colleague Sterling Hinchliffe, the Minister for Tourism, Innovation and Sport, and the Minister assisting the Premier on Olympics and Paralympics sport and engagement. Can I acknowledge the Shadow Treasurer, David Janetsky? Can I acknowledge Councillor Teresa Harding, the Mayor of Ipswich City Council? Can I acknowledge Councillor Kerry Hayes, the Mayor of one of our great coal mining communities, the Central Highlands Regional Council? Can I acknowledge all of today's sponsors, in particular Gert-Jan de Graaf, CEO of the principal sponsor, Brisbane Airport Corporation, all of the other distinguished guests, ladies and gentlemen. Well, g'day and welcome, and thank you for joining us today. It's clear from today's turnout that all eyes are on the Queensland economy, and I'm pleased about that. Can I thank the Queensland Media Club for prioritising our state's economy today and for inviting me to present the 2022-23 Queensland Budget Update. It's a big turnout because big questions need to be asked and answered. Big challenges lie ahead of us. Tough decisions have been made. But the results of those tough decisions has been an economic recovery plan that is delivering record results. Our economy continues to outperform. At the start of 2022, we were facing serious economic challenges. Not only Omicron, but a series of devastating floods and the global impacts of the war in Ukraine. As we approach the end of the calendar year, our record compares very favourably to other Australian states. Queensland's economy grew 4.4% in 2021-22. That is stronger growth than national GDP growth of 3.6% over the same period. Queensland's exceptional jobs growth has also continued. October's employment was 209,200 persons, or 8.2% higher than its pre-COVID level in March 2020. It's the strongest jobs growth of any jurisdiction over that period in both percentage and absolute terms. So Queensland is on solid footing. But there are risks on the horizon. Geopolitical instability is posing a very real threat to continued growth. The ripples of conflict in Europe are being felt across Queensland. The International Monetary Fund has downgraded its global economic growth forecasts. In its October World Economic Outlook, the IMF stated risks to the outlook remain unusually large and to the downside. On the home front, a tight labour market and the floods have limited domestic supply and have contributed to higher inflation. Inflation challenges are, of course, global. Central banks, including the RBA, are responding. They face a delicate balancing act, taming inflation without overshooting towards a recession. Whatever the future holds, though, Queensland is as well placed as anywhere to deal with future challenges. A strong economy has delivered significantly stronger revenues. Upward revisions have been made to total taxation revenue, totalling $1.7 billion over 4 years to 2025-26. In particular, strong labour market conditions are expected to deliver stronger payroll tax returns. As house prices ease, though, transfer duties are expected to moderate with a return to more normal levels of property transactions. Sustained higher coal prices, including unprecedented thermal coal prices, have driven royalty revenues significantly higher than had been forecast. Now, there's been some criticism of Queensland Treasury for not perfectly predicting this. As any Treasury official will tell you, forecasting is a complex task at the best of times, and Vladimir Putin has ensured these have not been the best of times. Our royalty revenue revisions of around $5.8 billion in 2022-23 reflect two things. Firstly, coal and gas prices being stronger than forecast at budget, and secondly, a weaker Australian dollar. On metallurgical coal, Treasury's price forecasts have proven largely accurate in US dollar terms. However, the Australian dollar was weaker, meaning the revenues to Queensland from coal sales occurring in US dollars was, of course, higher. The real surprise, however, has been the thermal coal market. For the first time on record, the premium thermal coal spot price has risen above metallurgical coal spot prices. This distortion has been caused by everything from flooding in the Hunter Valley, which has restricted supply, to European nations moving towards more thermal generation to reduce their reliance on Russian gas. The combined effect is that the price of thermal coal is up, and the effect is accentuated by the lower Australian dollar. So we intend to put those royalty gains to work, especially in regional Queensland. When we put the new progressive royalty tiers in place, we expected around $1.2 billion in additional revenue, which was allocated to new and improved hospitals in regional Queensland. Once again, we will allocate all the money generated by the new tiers to regional Queensland. We are reinvesting in our regions. Our new progressive royalty tiers will deliver an additional $2.95 billion this financial year. And today I can announce that we will set aside $3 billion in a long-term asset held in the Consolidated Fund dedicated to future infrastructure projects in regional Queensland. These new royalties that were earned in regional Queensland will not leave regional Queensland. Coal royalties are worth fighting for. Queenslanders deserve their fair share and they will receive it. The windfall profits made by coal companies are also a win for the people who own these mineral resources, the people of Queensland. That's what we did in last year's budget update when we set aside $2.5 billion as a long-term asset held by the Consolidated Fund. From our royalties, we will also invest an additional $1 billion into our government-owned corporations that own energy, water and transport assets. Another $100 million will go to the Queensland Critical Minerals Investment Fund, held by the Queensland Investment Corporation to support the next resources boom. $150 million will be provided for common user infrastructure to support critical minerals development. This will become increasingly important as Queensland looks for new opportunities to partner with the private sector, starting with vanadium, which is used for redox flow batteries. And we will renew the Resources Community Infrastructure Fund with an additional $120 million. The renewed fund will have a priority and a priority focus on coal-producing regions. It is Queensland regions that generate our mineral wealth, and they deserve to share in what that wealth delivers. That's why I'm pleased to announce today an allocation of $1.8 million to support Queensland's share of $3.6 million towards the replacement of the Phillips Creek Bridge on Saraji Road. Along with Commonwealth funding of $14.4 million and Council's existing commitments, this investment will ensure this project is now fully funded and can proceed. Now, I know that allocation doesn't sound like much in the context of the other numbers before you today, but I know this project means a lot, a great deal, to Councillor Anne Baker, who is the Mayor of the Isaac Regional Council. Most of you have probably never heard of Phillips Creek. Most of you have probably never driven over Phillips Creek. I did a few weeks ago when I was travelling from Moranbah to Blackwater. As the road dips down, you can see how easily it would be cut when there's a lot of rain. When that happens, it has a big impact on productivity of mines around Dysart, like BMA's Saraji mine. Through our progressive coal royalties, we will also make funding available for the Isaac Resource Excellence Hub. We're going to make that a top priority for this new fund, this renewed fund. And that will happen as soon as Mayor Baker and the other project partners bring forward the completed project assessment. The balance of the royalties uplift, around $500 million, will go to supporting other priorities and reducing debt. Severe weather events in Queensland can affect a lot more than just the Phillips Creek Bridge, so we must ensure our fiscal buffers continue to be strong. Queensland Treasury forecasts that the royalty gains we have seen this year will not continue at this level because coal prices will moderate. As you know, there's always some interest in Treasury forecasts for coal, and it's important to put this in context. Most forecasters expect that hard coking coal prices will decline significantly over the coming years to medium-term anchors that are much closer to the long-term average. It's worth noting that the Commonwealth Treasury has the adjustment occurring quicker and towards a lower price than Queensland Treasury. It's taken an appropriately conservative approach. That's what Queensland Treasury always does, and it's the right approach to its forecasts. Queensland Treasury assumes prices will normalise by mid-2023. On the screen, the thick maroon line shows our updated forecast for hard coking coal. Queensland Treasury's forecast, as you see, is realistic, with a higher forecast than Federal Treasury, as I mentioned. In fact, our price forecast is higher than Whitehaven Coal is using for its investment into the Winchester South metallurgical coal mine. When it comes to thermal coal, most forecasters expect that, given the international energy situation, prices will ease slightly but remain elevated for some time before adjusting to closer to the long-term average. Again, Treasury is positioned around the middle of the pack on thermal prices. Once again, Queensland Treasury's revised forecast is the maroon line you see on the screen. While some forecasters are higher, others, such as the Office of the Chief Economist in the Federal Department of Industry, Science and Resources and the Commonwealth Treasury, are lower. Westpac's forecast is also lower in the medium term. Now, if prices outperform that forecast, that is nothing at all to be ashamed of. It means mining companies are making more money, and the people of Queensland who own those resources are also making more money, a little over 20% to be precise. I've heard criticisms that Treasury's forecasts are too conservative. Of course, forecasts can go the other way as well. At the 2012 budget, the increased royalty rates introduced by the then Newman government were estimated to deliver a revenue uplift of $1.6 billion over 4 years. And these changes were expected to contribute to forecast total royalties of $11.8 billion over the next 4 years. However, prices fell sharply in the period following the 2012 budget. They remained at levels lower than forecast over the following years. As a result, total royalties paid by coal producers over that 4-year period were actually some 40% or $4.8 billion lower than the forecast at the time of the 2012 budget. But now, to return to the present. Since our June budget, a number of important government decisions have been announced. We are doubling the size of our Housing Investment Fund to $2 billion. That means $130 million will be available each and every year to support an increased target of 5,600 social and affordable home commencements. We're also putting $400 million towards the delivery of our nation-leading Queensland Energy and Jobs Plan. And we're investing another $400 million to deliver more resources, more personnel and more equipment for the new Queensland Fire Department and Marine Rescue Queensland. We're delivering $86 million in 2022-23 to provide a $55 water bill discount for households in the southeast. We can make these investments because of the strong economy our COVID-19 economic recovery plan has delivered. You may recall that the final $4.3 billion surplus for the 2021-22 financial year was the biggest on record. Well, for 2022-23, the surplus is going to be bigger again. A $5.2 billion surplus, driven by the revenue lines I described earlier. That means the deficit that was originally forecast for 2022-23 is now history. there's only one more deficit left in our forward estimates. Even though we've invested a lot of our increased revenue, we're also able to continue slashing our debt projection. Since 2020, every budget or financial update I have delivered has cut debt. As the Australian newspaper has reported, we have slashed net debt from $44.2 billion to $19.8 billion as at the end of 2022-23. That's an improvement of over $20 billion. And our net debt position has improved again today, as you can see on the screen. The economy has grown stronger and our revenue has grown stronger. That means debt continues to shrink relative to the size of our economy. Now, to put that in context, when COVID struck in 2020, Queensland and New South Wales were in roughly equal positions when it came to fiscal capacity. As I note, New South Wales, even with a proportionately higher debt, still has a AA+ credit rating like Queensland. We can see clearly how Queensland's COVID-19 economic recovery plan has delivered results. As our debt position has improved, New South Wales's has deteriorated. To put it in perspective, Queensland could borrow another $20 billion in the current financial year and achieve an equivalent debt position in per capita terms to New South Wales. That's important. Now, just to be clear, we have no intention of increasing borrowings to New South Wales levels. That's a sort of state of origin I like to win. But it's important to make the point. And the point is that we have a big buffer in place because there are significant challenges ahead. Energy prices, global inflation, the risk of global recession and bad weather. As difficult as the pandemic has been, the reality is that 2023 could be far more difficult, but in different ways. There's uncertainty on the horizon. But what we've done with royalties means Queensland is ready for whatever comes our way next. Queenslanders can be confident we have prepared our budget and our economic position to buffer our state from the wild winds of global unrest and of summer storms and cyclones. So thanks for joining me here today to hear firsthand the state of Queensland's economy mid-financial year. Majura, over to you. Look forward to taking some of your questions. Thanks so much.